Okay, I think we'll go ahead and get started. Welcome, everyone, and thanks for joining us today. I'm Glynis McClure with the Center for Ag Profitability at the University of Nebraska-Lincoln. You can find out more about the center, our decision-making resources, articles, podcasts, and an up-to-date schedule of more webinars on our website at cap.unl.edu. So if you have questions today, you can put those into the chat, or there is a question bar. So please, as we go through the webinar today, be sure to add your questions in as we go along. So at this hour, we'll be getting a review of the most recent data collected by the Nebraska Farm Business Incorporated in their annual Farm Average book about the financial standing for Nebraska farms and ranches from the latest year, 2023, and find out what that may mean for this year and beyond. Nebraska Farm Business Incorporated has over 400 producers in the state to provide financial analysis, business planning, and tax prep services for them. Presenting for us today is Tina Barrett, Director of the Nebraska Farm Business, Inc. Tina's been now with them since 2002 as the director. So she's got a long history and really knows her stuff. And I understand that Nebraska Farm Business, Inc. continues to grow under her leadership. So that's really awesome. I know she's an adjunct faculty member here in our Department of Ag Economics. So we're always glad to have and hear from what Tina has to share with us. She'll walk us through data about income, ratios, family living, and more, including how these points have trended over the past 10 years or so. Hopefully you can take information from today and apply it to your operation. Tina, good afternoon, and thanks for joining us. It's all yours. I'll turn it over to you.
Perfect. Sounds good. Thank you. All right. Well, these are literally hot off the presses, and there's some of the publications that we do with this are still being printed as we speak. So we just got this all done, so we just wanted to be able to share this with you. So let me go through just a little bit about Nebraska Farm Business, so just so if you're not familiar with who we are and what we do, as to where the data comes from. So Nebraska Farm Business was started back in 1976 as part of Cooperative Extension. And then in 2002, we kind of did a slight separation from the university, where we're now a private company, but still do a lot of work with the university as far as the teaching, the research and extension stuff. And so it's getting to be maybe getting close to where we've been out of on our private side and longer than the university side, which is a little strange for me. So as Glennis mentioned, we do a full range of financial work with farmers and ranchers in Nebraska. Really what we're charged with in 1976 and continue to do is try and use record keeping to help those farms and ranches become more profitable through the whole suite of financial services. The thing that we do, though, that is a little different than most accounting offices is the financial analysis piece. And that is where we get the information that we're going to talk about today. So, what we do is an analysis for the individual producers that helps them with their management, gives them accrual-based information, all their ratios. We can do some cash flow planning from that information, all of that. But what we do with that individual data is take it and average it so that we can have information like what we're going to present today, as well as for those producers to be able to benchmark their operation to the average and see where they can improve, see where things that they might be doing a little differently that is either better or worse. And so anyway, that's where this data is going to come from. So it's all actual farm data from farms that we work with around Nebraska. So usually I like to stick these charts to 10 years, but we're just going to dig right into the net farm income trend. And I went back and left it go a little bit farther. We're back to 2005 there, just because we're seeing a pretty major 10-year repeat. And we had those high profit years in 11 and 12 that seemed to repeat in 21 and 22. and the 23 net farm income, that's about as sharp of a drop off as we could get there. And so we ended up with a net farm income of about 38,000 this year. 2015 was like 35,000 when I indexed that for inflation. So not quite to that low point, but on that graph, but certainly close, and certainly the largest 1 year change we've seen in since 1976. So let me dig a little bit deeper. So that $38,000 average income has a range. When we look at the top and the bottom is about 1.5 million. That's actually a little closer than what we've seen in the past few years. But that basically means from the lowest income to the highest income was about a $1.5 million range. So certainly not every farm made $38,000. And that's something that's important to always remember when we're talking about averages, is it's just the average. So about 44% of the farms saw negative net farm incomes. So not quite half, but close. And that was basically the same percentage of farms that saw negative net income in 2015 as well. Doesn't necessarily mean it's the same farms or anything like that, but significant percentage of operations. In fact, if you would have asked me 6, maybe even 8 weeks ago, I would have thought we were going to end up with an average net worth or net income, negative net income, which we've only seen one time since 1976, and that was 1984. So luckily we did not hit that or break that record. So just to give you a little context, back in 2022, only 9.7 farms had negative net farm incomes. So again, going from 10% to 44% in 1 year was a very eye-opening and kind of shocking thing for a lot of producers. Our net worth change, we'll get to those numbers in a little bit, but that's the first time we've seen a negative net worth change or a net worth loss since 2016 on average. Again, certainly have had farms losing net worth, but not to this extent. And then we can slice and dice this data a whole lot of different ways. But one thing that kind of was interesting, and it probably will take a little bit more research into fully understanding why, but when we break things out by gross income, the $1 million to $2 million range were the only group that averaged a net farm income loss. And again, it might mean those larger operations typically have more livestock, and we certainly would have seen a little bit better income from those livestock operations, which might have pulled those larger operations back up to a positive. But you know, again, just an interesting tidbit as we continue to dig deeper. So again, we can break this down by profitability as well. So if you do look at our reports, you'll see things broke down by the high profit third, the low profit third, and then the average. Because that gives us a little bit different information. And you can tell from this 10-year or this 11-year chart that, you know, we're following the same trend lines. It's just that there's always those in that high profit third that are doing well, and then those in that low profit third that are just not doing so great. Now, these operations could be different every year. So I could have a farm that's in the high profit third 1 year and in the low profit third the next year. It's individual year data. But still the average of that kind of continues to follow the same trend lines. So outside of just net farm income, family living is certainly something I get asked about. So I want to talk about that just a minute and give you a look there. Again, got about 12 years of history there. Since 2012, we have been fairly consistently hanging out right at $100,000 of net farm or family living expense. Last year we broke through that and then increased that again in 23. So that blue is the family living cost. Again, just context, that's out of pocket cash things like food, medical, utility, non-farm utilities, non-farm vehicles, education costs, donations to charitable donations, things like that. It doesn't include capital purchases like the purchase of a vehicle or a house, doesn't include anything like maybe furnishings and appliances or those long-term things. Also doesn't include savings or investments. So those kinds of things would be on top of this 100,000. And then that kind of green or teal line is income taxes. And we'll talk about this a little bit more, because one of the biggest questions I got asked by individual producers was, if I lost money, why did I pay taxes this year? And there's certainly a disconnect between that cash basis income and the accrual income. But we'll talk about that on a couple different ways as we go through this data. In addition to that family living, that was 116,000. We had the income taxes. Like I said, we're getting pretty high because of that profitability from the last 2 years. That's really showing up on the tax returns now. So in total, by the time I add in all those other purchases, we're about 223,000. If I go back to that 2012 period, that was when we peaked for having the largest non-farm cash expenditures as far as a full, as including everything, where you can see we had a lot of non-farm capital purchases in 2012. And so still down from there, but still up from where we've been in between there. So one thing I like to point out as we go through this, because 116,000 doesn't seem like that much, but in order to get that kind of cash available to live on, if we're comparing this to a salary, I went and kind of worked backwards and said, okay, I need $110,000 to $115,000 of net income to spend on family living. I put in a 5% return to, or into retirement, $1,000 a month for principal payments, and the taxes needed to cover that. You would need a gross wage of about $190,000 in order to live like the average farm in our group is living. So I think that's really important as we think about, if you're not farming, there's not a lot of $200,000 jobs out there where you can continue to live in that same place. And a lot of times we think, okay, what's family living's not farming. But at the same time, if we're continuing to spend more than we make, it means that we're going to have to increase our borrowing needs, right? So I just went through very simple examples of making $75,000 a year, spending 21 on taxes, and 100,000 on family living. So we're spending 121, bringing in 75. So we're short 46. We've got to borrow that in order to do that. And then that continues to snowball each year as we continue to grow. And certainly with today's interest rates environments, that becomes more expensive than it was even 10 years ago. The other thing that non-farm spending does is contributes to that net worth change. So I mentioned that this is the first time since 2015 or 2016 that we've had a net worth loss. And so just looking through that calculation, we had that 38,000 in net farm income. Plus we had about 52,000 almost of personal income. So that would be wages, could be Social Security, could be rental income, could be non-farm businesses, right? So anything that just is not part of the farm. And then when I use the total that came out for family living or owner withdrawal, so that's a little different number than when we looked at the detailed family living spending, because this would include all the farms, not just those that had detailed family living. That's 118 plus 43 in taxes. And there's always a market value adjustment to get to our $80,000 net worth loss. So again, just wanting, as we making sure that that spending on the non-farm side becomes just as important as the spending on the farm side. Here's our net worth change trend. So this is not net worth trend. This is the change in net worth. So you can see the last 2 years, we built a lot of net worth on average. And so I think one thing that's important, and I usually try and point out to the producers that I'm working with is, okay, so you lost net worth this year, but you gained a lot of net worth in the past couple of years. So, if we were able to average that out, just I threw a trend line on there, those highs would fill in those low years, and we would be pretty happy if we ended up with 100 to 150,000 of net worth increase every year from an earned net worth change. And so it's important to think about that. Not to say that it's not alarming to have a negative net worth change or have that slip backwards, but we just want to make sure that over time, we're continuing to trend in that positive direction. Okay, so let's look at debt then just a little bit. And with debt, we're going to look at several ratios. So nothing more boring when you're full after lunch than a bunch of ratios, but we're going to talk about a couple of them. Hopefully we won't bore you. So A lot of times when we're talking about farm financial ratios, we look at the red light, yellow light, green light, right? So our three little pigs there kind of tell our story as to when you're happy and when you're sad. Um, Different organizations, maybe different, certainly different industries are going to have different standards for these ratios. So, take that into consideration. I'm using what the Farm Financial Standards is generally using, but just making sure we're consistent. So let's talk about a couple of those. So we're going to talk about liquidity ratios. So typically, well, not typically, liquidity ratios talk about things that are going to happen in the next 12 months. So your current assets are things that you're going to convert to cash or that are cash that you in the next 12 months. So your grain and feeder livestock inventory, prepaids, things like that. Your current liabilities, things that have to be paid in the next 12 months. That's your operating note plus principal and accrued interest on your term notes. And then we're going to look at gross revenue. There are some looking at gross expenses now. And again, it doesn't matter as long as you're consistent as you're looking at these things. So, and then, so again, just a couple definitions, make sure everybody has that same page. Working capital is current assets minus current liabilities. We don't have a great standard for that because it depends on your operation, but it essentially tells us how much cushion you have or how much is going to be left over after you pay those debts. So the bigger the number, the better, but sometimes, that's not always the case. I mean, you can have too much or it's not doing enough for you, depending on your goals for your operation. So we like to look at that as working capital to gross revenue. Again, your bank might look at that as working capital to gross expenses. And again, a little different, but you probably don't need to look at both, but you can certainly pick one and kind of trend that one for yourselves. Again, this one hasn't been around a whole long time, so these standards can vary a little bit. And there are even some economists who will say that in good times, you can have that be as low as 25% and still be in the good, but when things are tight, that number needs to be higher. So might have a little bit more flexibility in those standards. I went ahead as far as the average goes and put that line at 33%, just to give you a goal line. So again, man, the repeat that seems to be happening, looking at 2011, 2012, and a couple years after seems to be repeating itself in 21, 22, and we're starting to see that come back down. So liquidity is still on an average basis above that goal line. But if you look back into that 13, 14, 15, you can see how quickly that dropped and how long we stayed under that line. And really thinking back and taking, or what, it took 2020, it took COVID, it took all those government program payments and a lot of those things to really bring us back into a healthy position from a liquidity standpoint, then followed by a couple of years of good profitability. So I think what's important here is if you're watching this number drop, to make sure that you're really protecting that working capital, since we're not really seeing that end in sight for what maybe is coming from a profitability standpoint. Again, I like to dig a little bit deeper and look at these numbers a little bit closer because, again, nobody's average. So what I've done is taken the percentage of farms that had negative working capital, and those are in that red quadrant. So overall, we had about 20% of the farms that had in the red, so less than that 10% working capital, and that dark red would be those that have less than 0%. So they basically have negative working capital, right? So 13% of the farms that we work with really struggling from a liquidity standpoint. On the flip side, almost 70% are sitting in that good position in that green. So we're seeing that large section there. And of that, 35% are sitting with more than 80% working capital to gross revenues, which probably means that if they're using an operating note, it's for a very limited time of the year and really just for timing of sales more than financing needs. So I think that's interesting. This is the same thing just from trend. So same thing as that pie chart. So each color is representing the percentage of farms that year that would have fallen into that category. And I have the green split into good and really good. And I have the red split into bad and really bad. But again, I think this one shows that how quickly that deterioration happened in the working capital. And then we saw that improvement as we came through 2020, 2021, really saw a lot of operations sitting in a good position. But you can see 23 that red area increased and got quite a bit bigger. But I also think it's very interesting that we had an increase in the number of farms that are sitting in that over 80% working capital to gross revenue as well. And really what that tells me is there are some operations who use the profitability from the last 2 years to really get in a healthy financial position and be prepared for this downturn. And then we have that smaller chunk, that 20% at the top that, is really still struggling and maybe is not prepared for a downturn. So, really working capital is something that that you feel. I always tell my students that I can usually tell how a farm's working capital is when I sit down at the kitchen table and we start talking, because as a producer, you're going to feel your working capital. So if you're up against your operating note limit, if you've got bills that you can't pay, those kinds of things, it's very easy to feel your working capital and your liquidity pain. And it's less easy to feel some of the solvency things that we're going to get into. But it's really important that we have that working capital, that we have that cushion, because not all of our expenses are included in that calculation. And so we still need to have that working capital to pay those other expenses. Or we're looking at increasing debt. And again, that's one of the reasons why your lender's caring about that. So let's talk about solvency then. So, and maybe back up. So when we talk about liquidity things, those ratios move more frequently. They're a little bit easier to change. I always, again, try and equate that to say liquidity is like your heart rate or your blood pressure. They're going to change daily. It's going to, fluctuate. There's ways to improve those, relatively easily. But your solvency ratios are a little bit more like your blood pressure or your cholesterol level. Your cholesterol level or your weight. It takes a little bit more work. It takes a little bit more focused time, to bring those things and change those numbers. So when we talk about solvency, we're talking about our total farm assets and total farm liabilities. And again, it's really important as we look at these ratios and you start comparing to your farm. We look at farm assets and farm liabilities. You might see a debt to asset ratio that includes all your assets and all your debt, including those non-farm things. And which is fine. It just makes sure that when you're comparing things that you're comparing apples to apples, because those will be a little bit different depending on how many non-farm assets and liabilities you have. So again, we're looking at everything that would be related to the farm in these cases. And there's really three major solvency ratios, but they kind of take these three categories and work them around different ways. So we typically look at debt to asset as the most often one. So that's what we're going to talk about. Again, your bank might look at debt to equity or equity to asset. But again, it's just rearranging the same numbers over and over again. So what debt to asset ratio shows us is basically how much of the operation the bank owns of your operation, right? So the higher that number, the more risk you have and the less of your business that you own. So we like to see that number under 30. When it gets to be over 60, there gets to be some concern. Again, really understanding your operation and how that fits, your number could be different. So if I had a 25-year-old beginning farmer in my office, I wouldn't expect their ratios probably to be under 60. But what we would want to be watching there is to be watching their trend and making sure it's working in the right direction as they build their operation. But if I have a 60-year-old operator in here with a debt to asset ratio of 80, then, we're not looking at maybe how we can build that and improve that as we're trying to work on an exit plan. Okay, so let's look at the average debt to asset ratio was in 23, ended up at 27%. So a slight increase over last year. Again, you can think about all the changes and all the fluctuations in profitability we've seen over these 12 years. And the debt to asset ratio just doesn't move very much. Again, it's just not one of those that is really reactive. Again, unless you're a beginning farmer with relatively small numbers on your balance sheet, then, you know, a little change might make a big change in that number. But for a lot of our average or, you know, full-time producers, this is just isn't going to move very much, especially on an average. So, we're still sitting below that, did creep up above average or above the goal line of that 30% for a couple of years on average. But have not seen a lot of movement. I did the same thing as I did on the current ratio with this debt to asset one. So looking at the percentage of farms that would fall into those categories. And again, I did a bad and a really bad. So that dark red would be those above 80% debt to asset ratio. And you can see, we can see a little bit more movement this way than we can just in the average. And you can see that deterioration of the number of farms that were above 60% leading up into 2020. And again, it's a combination, and I don't think I can dig into the data enough to know, you know, maybe just the effect that the forgiveness of those PPP loans, the receiving of the employee retention credits, and some of those other programs out there that became in 2020 that really hit the balance sheets in 2021. And made a significant impact if a lot of that improvement was due to those sorts of programs and things. So, you know, one of the things that again I heard a lot this year was things like, so if I lost money, why are we paying taxes, and why are those kinds of things, and really a lot of that comes back to this snowball effect and how this impacts your debt load as well. And so I've got just fairly simple example again of just holding taxable income relatively low, spending more than that on family living every year, and what that does to your operating note and your carryover inventory. So I'm going to walk through 1 year here, and so we just have it starting in 2020. We've earned 50,000. So on an accrual basis, we had accrual earnings of 50,000, but only wanted to recognize 35,000 on the tax return, right? And so that means there was 15,000 of inventory that wasn't sold, right? That's how we would make that happen and carry that inventory into the next year. No big deal. Okay, so we've got that sitting here. And then spent 40,000 on family living, but we only had cash income of 35,000. So that means we would have had to borrow 5,000 to cover that expense. Okay. Again, you've got a $15,000 asset, a $5,000 liability. We've got, you know, really great working capital, not a problem, right? All right. So the next year, we would come around then and have the same thing. We made a little bit more money. Had kept the taxable income the same, spent a little bit more, so that we added it. Now we have 10,000 more than in family living than what we recognized. So we're going to add 10,000 to that operating note, and we're carrying over another 40,000 of inventory because we didn't want to recognize that income. And so our inventories are growing, and you can see it doesn't take very many years before that operating note is increasing and that carryover inventory is increasing. And so but you know, this year might have actually ended up a little bit more like what I've got listed or labeled here as a 25, where we had a low income year, but we still needed to have a taxable income of that same amount. So our inventories actually dropped, right? So the problem that we see with this on average is we've seen those inventories increase. We see that debt load increase as we try and control that taxable situation, waiting for a year like this where profitability is down a little bit, where we can reduce those inventories. The problem is a lot of times we've built inventories to the point where it would take a lot of zero or loss years in order to eat up that inventory. So it's an important thing to watch for, because we really can't get rid of that debt. We can't get rid of that inventory without paying taxes. And that's always a not fun scenario to getting out of this. So yeah, we pretty much covered that. So the other ratio I was just going to talk about briefly is just repayment capacity. And I think there's some interesting things that are popping up out of the data in that one as well. And really the repayment capacity ratios are just looking to show that your ability to repay debts, right? So if we look at the calculation for repayment capacity, we have that net farm income number, adding back depreciation, adding in non-farm income and family living. and then adding interest on term nets. So we have a capacity to pay $111,000 for term debts. But our average scheduled term debt is 154,000, which makes our repayment margin a negative 43,000. Okay, not something again that's surprising when profitability drops like this. We look at that repayment margin over time, and again, it just seems to be like this repeat. And unfortunately, we're sitting here looking at how long is it going to take us to get back to that 2020, 2021 profitability level. But one of the things we saw back in 2011, 2012 was a lot of purchases with borrowed money. There was all kinds of debt repayment capacity because of those high profitability. And then we went through a lot of years where it was really hard to make those payments because the profitability just wasn't there anymore. And I think we saw again that repeat in 21 and 22, a lot of purchases have the profitability, but we're going to put it off on time. And now it's a struggle to make those payments. As I was looking at this, I went back and tracked term debt payments, just because those numbers started to look pretty big. So I thought this was also fairly interesting. So 10 years ago, we had on average 60,000 of term debt payments. And this last year, we're getting close to 160,000 in term debt payments. So we've added almost $100,000 of annual payments, and really haven't changed the size of the operations very much. The other thing that obviously comes along with debt and the conversations in the last couple of years would be our average accrual interest expense. And this one's a really hard one. I tried coming up with different ways that we could slice and dice this and really understand it. But again, just the way that the data is collected, it's kind of hard to know, is this operating debt interest, is it intermediate, is it long-term? And that's really important because as we talk about interest rates increasing, there's a lot of that land debt and even that intermediate debt that's locked in, for at least the short term, and not going to be impacted by the interest rate increases unless we're talking about buying new land or we're talking about replacing that equipment. Because as you roll that equipment, we're going to get rid of those nice cheap interest rate loans and replace it with high interest rates. So we probably will continue to see the impact of interest rates as we go over. But what I've got on the screen there for you is a chart that shows the kind of teal bar lines, our total debt. So you can see how we've increased debt over the last 15 years. And then the accrual interest expense in that time. So actually we got into that 2018, 2019, had average interest expense like this. Again, that operating debt would have been very high at that point. As we were getting to the point where we were getting kind of to the end of that low cycle. And we've certainly come back to that peak of average interest expense. So again, we're looking in that 30 to 35,000 average interest expense for that accrual period. And like I said, I got, that debt is increasing. I'm going to take that interest line off. So going back to just debt. I think it's interesting that 2021 is pretty much the only time in the trend line that we've seen a decrease in debt. So I think that is interesting to see as it correlates with those PPP loans forgiveness that would have reduced some debt with tax-free money, since we didn't have to pay tax on that forgiveness. And so that if that's the correlation in there, or if it was just a timing or other thing that would have caused that debt to decrease really for about that only time that's happened. I do like to look at debt as different categories as well. So this is a little bit of a time lapse look at debt. But that light blue on the bottom would be our current. So that's your operating notes. The intermediate is that more teal color. And then we've got the green long-term and then the orange non-farm. So every category of debt continues to increase. So it's not like we're seeing that debt increase just because of what it costs to buy a quarter of ground, which is obviously a lot higher than it was in 1998. Certainly it costs us a lot more to put in an acre of corn as well. And definitely know that equipment cost has increased as well. So all of those costs increasing and certainly increasing the debt load. But if on average, we're running about $1.5 million worth of debt, Again, thinking through the average process in that, we have some operations that are operating without debt. We have some operations that are operating with a lot more debt than this. And as we increase that risk and that potential for, maybe a falter or, a bankruptcy, that impact is going to be significant. So, all right, let me get into, some per acre stuff for you before we run out of time. But this is irrigated corn. This is all tenure type. So I've taken owned, cash rented, and share rented ground and kind of mushed it together. You can see we were really on a tight margin there from 14 to 18, even in the 19 before we saw that profit start to increase. But even in those tight times, it was pretty tight and not inverted. And you can see in 2023, we actually had a fairly significant loss per acre. Again, sometimes I like to figure out just why. So it's the same thing. I just threw in the average corn price received. So that's that dotted line. And you can see again, in that 12, 13 time period, maybe the impact that those yields and that drought time really had, in addition to what potential there was just from the price. But in the last couple of years, that price and gross income have certainly coordinated. And again, this is irrigated corn. So we're not seeing the full impact of that dry land condition. So if we dig into costs a little bit, and I just keep adding to this, because every year there's something important going on there. But so let's think back to 2019. That was the first time we saw $4 corn and saw profitability and things looking good. And 2013 had been the peak year for costs. We were able to pull costs down after that into that 2018 time period, where we kind of saw a new lull. And then costs have just escalated quite a bit since 2018, where we're now looking at, and this is irrigated corn on cash rented ground, where costs are exceeding $1,200 an acre, really almost twice what we were seeing in 2019 or 2009. And again, all the costs, fertilizer is certainly the one that pops out there in 2023. But our operating power and machine costs, even our overhead is up, 50% over what it was in 2021. So certainly all costs are starting to creep up. Like to take a look at that. So I take those costs and divide it by our 10-year average yield of 220 bushels. That's a cost of production of $5.57 a bushel. Not a lot of marketing happening at that rate today, and that's just farm costs. So let's take that one step further here and add in what we would need for a family living. So I've got the family living income taxes, and I took off that non-farm income. So what that means is I need $110,000 on average for each farm to cover those costs to basically make sure we don't have a net worth loss, right? Our average acres was about 1,380. So that cost means we have about $80 an acre in non-farm costs that we need to cover, or at 220 bushels, 36 cents a bushel. And so that brings that total cost of production to just right at $6 a bushel. That's what we would need on average to sell corn for in order to not have a net worth loss. I went through and kind of projected out some of those costs, brought fertilizer down a little bit, crop insurance down a little bit because the price is down, and kind of tweaked everything else. And really, by the time we're all said and done, I don't know that we're looking at a whole lot of cost difference in 24 versus 23. And obviously, it's important for you to look at your operation and how that goes. But as far as a projection, I think using 23 is probably as good as it comes. But I did use those 24 cost productions and averaged it or rounded it off to $1,200 a bushel, or I'm sorry, $1,200 an acre, and used a couple of different yield projections. So again, depending on where we're at yield wise, if we ended up a little above average, maybe 490 would cover that cost. But if yields are slightly down and maybe even down enough that they're not really getting a whole lot of help from crop insurance, if you're in that top 20 or 25%, depending on your coverage level, We could easily be looking at well over $6 a bushel, depending on what that yield does. I also went ahead and did soybeans. We see that inversion a little bit more with soybeans over trend. Certainly saw, fairly significant loss per acre, almost $100 an acre there in 23 for irrigated soybeans. I ran those same kind of numbers for you just to get cost of production, including that $1.14 per bushel, because we got a lot less bushels. So covering the same cost over less bushels is going to add up a little bit more. We need $14.60 a bushel with beans at a 70 bushel per acre yield. So yeah, doom and gloom all over, right? That's not the fun news of the day. One other thing I wanted to pull out of the per acre stuff was just this machinery cost per acre. We look at this trying to equalize how people own and get their equipment needs met. So this includes fuel and oil, repairs, machinery depreciation and interest, custom hire, and machinery leases. So pretty much however you're going to get that, got it all thrown together there. But I found it was interesting because we have seen such a consistent number for so long, and then have seen that number increase dramatically. So again, almost another $100 an acre in machinery cost from 2020 to 2023. And so it's certainly an area that is worth looking at quite a bit. So the questions is a good thing of what do you do, right? It's a question I get quite a bit. Don't exactly have all the answers right there, but what I do know is it's important to know where you've been and where you're going, and making sure that you're telling your numbers what you need them to do. So, looking back and analyzing your business and understanding where your costs are, because these are averages and our costs would, when we dig into that, are all over the board. And it doesn't matter if it's the county that you're in, or what your brother's costs are, or what anybody says, your numbers are going to be different. And it's amazing how that works. But I see enough to know that that is absolutely true. So knowing and understanding your numbers is step one. And once you have that done, then it gives you information that you can build that cash flow that gives you the ability to look forward, and you can make decisions that make sense for your operation rather than just what you've always done, or what that works for the neighbor, or what works for somebody else, on a state away. So when I talk about a cash flow, I talk about a working cash flow. I don't think the cash flow that you do in January and give to the bank and then put in a drawer and ignore is not what I'm talking about. I think a cash flow that's written down, that you update monthly or at least quarterly, is really important, because the day after you make a cash flow, it's wrong, right? Something's happened and it's going to be different. So be able to put in there what's going to happen if prices go up or down, or if your yields go up or go down, or what happens if fuel prices skyrocket in the next few years. Having those kinds of flexibility to play with the numbers and anticipate those changes is going to be very important. I think it's important that your cash flow works with your tax plan and your marketing plan. Those things need to go together, because you can do a lot of great things to make money and then get to the end of the year and your tax bill is not what you want it to be. And we end up having to undo a lot of that profitability. And I think it's important that you work your cost of production estimate, and you got to make sure that you include all your costs. So it's really easy to look through those production records. But what we see is when those production records don't exactly match your cash expense, and that discrepancy can be significant. So if you're working off of something that has cost of production, make sure you're multiplying that out and making sure that matches what's in that category for your expenses. And then again, all of this is great, but if we're not looking at it on an accrual basis, you're probably not giving yourself good information. You need to be able to look at that on an accrual, and what we put on the tax return is just what we've decided that it needs to be going in and out of your account. That's why you do tax planning. So it doesn't give us a lot of management value. So finding that way to do that accrual adjustments is really important. Okay, so I just have a couple of things. Again, I don't know that that's anything different or anything earth shattering, but things I think that's important for people to look at. I think cost control is going to be important, and that goes for farm costs as well as non-farm costs, and both are hard to control. But thinking through just doing something just because that's the way you've always done it, or that's the way Dad did it, it's going to be an important time to really analyze each of your decisions and make sure that that's the right decision. We are not looking at a place where tight margins are not going to be there, right? So, I think at some point in time, the costs have to be less than commodity prices because people have to eat. And in order for that to happen, there have to be farmers who are able to produce that food, right? So, it feels like we at some point we've got to be there. So just making sure that your financial situation can withstand a couple bad years as we adjust and get this, find our new normal, is really important. So watching those tight margins. Minimizing income taxes at all costs can end up costing you. So be aware of that. Make sure that the tax decisions that you're making are smart management decisions. If you're spending money on equipment that you don't need just to save taxes, that could end up costing you more in the long run. So make sure that you're making smart management decisions as you're doing that tax stuff. And remember that you can't reduce debt if you don't pay taxes. And if somebody's got the magic secret to how that can happen, you let me know. I mean, other than inheriting a bunch of cash or something like that, there really isn't a way to beat that. Or I guess passing away as an active producer, but not very good options as how you can do that. So think through that one. And I think tax planning early is going to be important. A lot of times people feel like tax planning in poor years is not as important, but in a lot of ways it can be the most important thing. And if you're used to using equipment purchases as a way to get out of your tax situation, just be aware of what the tax laws are doing as we start to phase out bonus and waiting for Congress to make a decision on how that could be done. We just want to make sure that we're doing those in a right way. I also wanted to make sure that you guys were aware on our website. So if you go to nfbi.net, under that farm analysis, you will find our annual reports. So all the data that we have, the electronic versions are available and up there. So you can order those with that bottom link. So just again, over to farm analysis, and you can get down to those annual reports there's a lot more data than what I went through available in those reports. All right, let's see if I've got some questions. If you've got questions, go ahead and feel free to put that in the chat for me, and I will do my best to answer that. I see Ryan did put the link to the website there in the chat for you as well. So.
Yeah, thanks, Tina. Just a question while we're waiting. There might be some other questions. So it was interesting, $150 of overhead was kind of some, in that ballpark. What do you have included in that, just to let folks know?
It would be farm insurance, utilities, depreciation on machinery and buildings, some miscellaneous expense. Trying to think, I think building repairs would be down there.
Okay.
Those kinds of things. Yep.
But pretty much cash types of expenses, yeah.
Yeah, no, those would all be cash expenses,
Right.
outside of depreciation. So doesn't include any opportunity costs, as we're looking at that, but.
Okay, we do have a question on, is crop insurance cost and benefit included in this analysis?
Yep. So crop insurance cost is included in the direct expenses, and any of the income back would be included in that gross income. That was
if there were any received.
If there was any, payments out.
Okay.
Yep.
Okay, very good. I was going to ask also, so you have your range of high and low profitability farms. Do you see, and I don't know if you addressed this, but those that are low profitability, are they generally the ones that are carrying more debt?
Again, it's hard to know because again, we're looking at those splits, those are annual splits. So, it could be, an operation that was in the low profit third this year, that could be in the high profit third next year. And so that's a little bit harder to really follow through and know if that's an issue or not. One of the things that we do, and I didn't put any of those slides in today's, is we look at what we call our top efficient group. And we looked at those farms who were routinely getting a net income ratio of over 20%. And when our average was running about 12 to 13%. And when we did isolate those farms and hold that group consistent, we did notice that group has a lot less debt, and maintains that. But I think we're always going to have operations in that high profit third that are carrying us, fairly good debt load too. And some of that is also goes back to just the goals of the operation. If, we have operators who have achieved the size that they want, and are more in a consistent standpoint, the debt is a little different than those who are actively trying to grow. So.
Yeah, we have another question. I think this is a good one because, what are we seeing between the crops and the livestock differences? But are the farms that are consistently staying in the efficient group diversified farms?
Yeah. So again, it's not. They're more crop operators, but not because you can't be an efficient livestock producer. Just the way that the software that we use calculates that net income ratio, which is what we chose of how to pick that group. When you have especially purchase feeder livestock, that the program uses that as a expense when you're buying those animals. And so that makes your net income ratio not really comparable to a crop grade or a crop operation, very much. And so in that top efficient group, we're not seeing a lot of diversified operations there, but it's because of the calculations and show, really highlights the importance of, why those ratios are a little different for one industry versus the next. If we looked at this year's numbers, we're going to see most of our livestock operations we're certainly in that high profit or that positive position this last year, because things were just better in the livestock area for the most part than they were for the crops.
Okay, and then there's another question. Do you think family living withdrawals will go down for 2024?
I think it's hard anytime once, it doesn't matter if it's a farm family or anyone, once that standard of living reaches a level, it's hard to pull it down. And it's also hard to know that did that standard increase, or was it just inflation of costs that we all know it costs more to buy food and to, do all of the things than what it used to cost. And so those things are going to be hard to pull down. Is there operations that could reduce their family living costs? Yes, for sure. And so, again, that's an individual thing. I don't know if we'll see the average drop significantly. Again, it's been pretty steady. So.
Right. Again, you account for the family living separate from the income tax payments, correct?
Yes. Yes.
Right. Okay.
Yep.
So another question, intermediate debt seemed to jump up in 2023. Is that primarily equipment debt? And if so, was it a bump in the number of equipment purchases perhaps, or the cost per purchase, do you think?
Yep, it's hard to quantify that. That is equipment. The only other thing that would probably, again, intermediate, we're talking 2 to 10 years. So somebody who maybe bought a lot of breeding livestock would classify that as an intermediate debt. So it could be either one of those. Most likely it's equipment. Certainly we saw the cost of equipment going up significantly. So it could be that. I don't have the ability to, go look at the number of debt, number of loans that maybe were in that. The other thing I think that is a real reasonable possibility as to why that increased so much is because the profitability of 2021 and 2022 are hitting those tax returns pretty hard. And again, I know that there's a lot of equipment being purchased to control that tax situation, using the 179, using bonus, and then putting that on borrowed money. And again, the scary part of that is now we've got to make those payments with principal, which is not deductible. And so we've taken the deduction for it. We've got to make the principal payments, and we're losing the profitability. So it makes it a little scary.
Okay. So, and I really liked your note about working cash flow. You know, it's like, it is something to kind of keep track of as you go.
Yep.
And I just wonder, and cost control, you know, I work on cost of production budgets here, but also I think I'm just a plug for our ag budget calculator program. If folks aren't familiar with it, we do have a monthly cash flow built into that. And so as some things change, you can actually see how that changes. So just a plug there on our end from the Center for Ag Profitability. Another question just came in. Let's see here. Do you see, see if I can grab it here. Can farmers use retirement plans for tax deferred equity growth instead of carrying more inventory and potentially more operating debt at these higher interest rates?
Well, I mean, retirement plans, I mean, there's a lot of retirement plans out there. There's some that allow you to put in, you know, a significant amount of money that, you know, that can certainly, you know, do some different things. Yeah, the tough part about that is anytime that you're putting a significant amount of debt into a retirement plan, you don't have it for operating anymore. And so that's hurting that working capital. And so it really depends on the situation that the farm is in and how much debt they have as to whether or not that, you know, that's a good option or not. And, you know, the other part of, you know, using tax deferred retirement options is, you know, right now we really have the cheapest tax rates and that we could have through 2025. So another 2 years of these lower rates and the use of the 199A deduction where, you know, you get 20% of your income free from tax. And so, you know, the challenge is that do you defer these low rates and then have to take out and pay tax at a higher rate when you retire? And if you're looking at putting it into some sort of a Roth that's going to grow tax free, you know, then we're not getting that. We're losing the working capital and we're not getting a tax deduction today. So sometimes that can be a tough one too. And again, it's a hard question, but it's certainly something that I think is worth talking with your tax preparer about.
Okay, good. All right, well, I think we're right up against our time, and I don't see any other questions coming in. So I think we really appreciate, Tina, your time and all the good information you provided. I always learn, always reminded of some really good points as we do farm analysis and tax management being so important too. And thank you everyone for joining us today. Recording of the webinar will be posted at cap.unl.edu, where you can also register for upcoming webinars. And as you click out today, you should see a short survey appear as you, you know, again, end today. We really value your feedback. So please take a moment to submit that quick survey, please. Next Thursday, June 13th at noon, we have legal restrictions to foreign land ownership. Dave Aiken here in the department will be presenting that information. And again, stay in touch with CAP if you have questions. And thanks everyone for joining us today. Enjoy the beautiful day that we're having. Thank you.